and welcome to Dynamic Trader Tutorials, the Price Series. This is tutorial number 1, Beyond Fibonacci Retracements. In this tutorial, you're going to learn about using internal retracements and alternate price projections to identify support, resistance, and trend reversal price targets in advance. So without further ado, here's Bob Miner, founder of Dynamic Traders Group, to get us started.
Well, hello, I'm Robert Miner, and welcome to my trading room, and welcome to our Price Series tutorials, this first in this series, which we call Beyond Fibonacci Retracements. What we're going to teach you in this first of our Price Series tutorials is how to identify in advance which retracement level has the highest probability of being support or resistance or trend reversal. And we're going to do that by teaching you about internal retracements and alternate price projections. This is going to put you way beyond the typical sort of trading education you get about Fibonacci retracements, because I want to emphasize we're teaching you how to identify in advance, before the market gets to these retracement levels, which retracement level has the highest probability of the trend reversal or being significant support or resistance. So let's get started with this first tutorial we have in this series, our Beyond Fibonacci Retracements, and learn about internal retracements.
Okay, let's get started by talking about internal retracements. Internal retracements are the retracements that most traders are familiar with. They're less than 100%, and the most frequently used ratios are 38.2%, 50%, 61.8%, and 78.6%. Now the 78.6 retracement may be new to many traders, and we use it specifically in the dynamic trading approach. It's the square root of 61.8%, and it's an extremely valuable retracement level. And we'll show you how that works here in a minute. In a later section of the Price tutorial series, we're going to teach you about external retracements, but in this particular tutorial, specifically talking about internal retracements and alternate price projections.
All right, let's just do some retracements, some simple internal retracements. Now, I realize most of you will be familiar with these, but we're going to go over it quickly, the basics, to make sure that we're all on the same page and we are all familiar with the same language. So we're going to do the internal retracements of the most common ones, which are the 38.2, 50, 62, and 78.6%. So we want to make sure in our retracement tool that we have the proper retracements chosen. And so we've got chosen the 38, 50, 62, and 78.6%. And on our tool here, our menu for retracements, is that I've chosen to make all of these lines blue so they're easily identifiable when they're on the chart as retracements. And notice that I've made the 38.2%, the line is going to be thin as opposed to thick, because the 38.2% retracement is only really useful in certain circumstances. It's not one of the real key retracements that we typically look for support and resistance, other than maybe just temporary support and resistance. So we've got our ratios chosen, we've got how we're going to display them chosen. So let's click OK and let's do our retracements. And it's very simple. As we choose our retracement routine and we mark off from the high to the low. And let me square the chart up here a bit. Bring all the bars back on. And we have all of our retracements on the chart. And we can see as of the high of the data that we have in this chart, it looks like it just hit the 50% retracement within a couple ticks of it. But we've got displayed the 4 retracements. And in our Dynamic Trader program, it shows you all the relevant data for any retracement. So it's real clean and we can easily see it on the chart. We have the exact price of what the retracement would be. We have the label of what kind of price projection it is, in this case a retracement, and then it shows the exact ratio used for each of the lines. So that's how we do internal retracements, and almost every software program, I think every technical analysis program, allows you to do retracements. And again, most of you are familiar with them, but now we know throughout this course how we're going to do them, and how they're going to be displayed. So we have the retracements on the chart. We know we made a high here. The question is that a trend reversal high, just a temporary high? Well, next we're going to learn how to do alternate price projections, and when we add those on our chart along with the retracements, we will be able to identify in advance which retracements have the higher probability of actually being support, resistance, or trend reversal once we have both retracements and alternate price projections.
Okay, as Bob mentioned, in addition to internal price retracements, we also use alternate price projections as part of the dynamic trading approach. We also call these APPs. Now, APPs compare swings in the same direction or alternate swings. What we know about cycles, counter trends, and trends is that most highs and lows are made at or near an APP. And the most common ratios we use for APPs are 61.8%, 100%, and 162%. So let's go back to Bob and let him explain a little bit more about how alternate price projections work.
Let's see how we do alternate price projections. Now, with alternate price projections, we're comparing swings in the same direction, otherwise alternate swings. So, for instance, with this data, which is the same data we used for our retracements, if this market continued to advance to up above this new high, we would want to compare the price range of the first swing up by certain ratios with the next price, with the price range of the next swing up. So in alternate price projections, the three most typical ratios we use are the 62%, the 100%, and the 162%. Well, let's add some data onto this chart, and we first want to see if the market does take out this high. We're then going to make our alternate price projections. So we're in our training mode, so we can advance the data bar by bar. And as of the last bar on the chart, it's made a new high. So we're going to compare the range from this first swing up with the next swing up, given the principle that most alternate swings make their end of their swings are the support or resistance in one of the key ratios of alternate price projection. Now I'm going to just label this swing down that we have so far. So we're going to go to our alternate price projection menu, just like we did with our retracements, and we're going to make sure that we have the 62, 100, and 162% alternate price projections checked off. And all of the alternate price projections are going to be in red. So they'll be in red so that we can identify them clearly and easily on the chart. And notice that the 62% has a thin line. It's going to be a thin line on the chart because the two key ones are really the 100% and the 162. We do want to be aware of the 62%, but the most important is 100 and 162. So we've got them, how we're going to display them all set up. Let's click OK, and then let's do the alternate price projection by measuring from the first low to the first high, and then we're going to make those projections from the next low because we're comparing swings in the same direction. So we're comparing probable resistance of this rally up from the second low. That range will probably be at or near one of the ratios of the first swing up. So we have the three alternate price projections on the chart. And just like with the retracements, at least in our dynamic trader program, is we have all the relevant data right on the chart, right on the line with each of the price projections. So we have the actual price, we have what type of projection it is, APP, our alternate price projection, and the ratio that was used to make that particular projection. So we've made the three projections on the chart. Now we can just take off the projection that's below this high, so let me erase that just to clean the chart up. So we're left with two alternate price projections, the 100% and the 162%. So that's how we do the alternate price projections. They're very simple, but they're very, very powerful, very, very helpful. Now let's go on to our next little section or recording and see how we combine the retracements and the alternate price projections to identify in advance which retracement is most likely to be support or resistance. And again, I want to stress, identify in advance.
Well, we hope you can see how powerful it is to use alternate price projections as part of your trading strategy. But now let's take a look at how much more powerful it is to combine retracements and alternate price projections. So the alternate price projections are helping us identify in advance which retracement is most likely to be support, resistance, or trend reversal. If one of these retracements does not have an alternate price projection near it, it's not likely to be support, resistance, or trend reversal, so we can actually eliminate it. With the dynamic trading approach, we use tools and techniques that can identify in advance high probability support, resistance, and trend reversal zones. So if by combining the retracements and the APPs we can eliminate something, we certainly want to do that, so we only focus on the areas that are high probability in advance targets. So let's go back to Bob and see how we combine retracements and alternate price projection.
So here we have the same data on the chart with the alternate price projections on the chart, but now we want to add in the retracements. So we have both alternate price projections and retracements on the chart, and we'll see how we look at both these types of price projections to help identify which retracement level is most likely to be support and resistance. So our alternate price projections help identify which retracement is most likely to be support and resistance. So let me put the retracements back on. Measure from that high to low, the same ones that we had on earlier. And I'm just going to take that line off the chart because it's going through this text. And we have now, let me also take this 38% because it's below, well below where the market's at. And we can see we have the 50%, 62%, and 78.6% retracement. Now that retracement should be blue. So let me change the color of that so all of our retracements are the same color. They're blue and the alternate price projections are red. We can see that the 100% alternate price projection is well below the 62%. It's closer to the 50%. So we don't have an alternate price projection that's close to that 62%. We do have one that's close to the 78.6% retracement. So more than likely, this 62% retracement is not going to be significant support or resistance. It might be temporary, but not significant because we have the alternate price projection close to the 78.6%, and that's probably going to be a more important and higher probability resistance area if the market continues up. And traders that do just retracements, with the market coming to the 62%, they might say, well, it made a nice reaction against the 50%. Now it's at 62%. That's an important retracement level. That's probably going to be resistance. But we know, because we've done the alternate price projections, that more than likely that's not going to be a significant resistance area, but the 78.6% probably is. So let's add some data on the chart and see how this turned out. Again, we're in the training mode, so we can go bar by bar. Here we got a little reversal day right near the 62% retracement. But the market continued up sharply, and as of the last bar on the chart, it just tagged the 78.6% retracement. Now, is the market going to keep going, or are we going to find some resistance here? Well, because we have both the 78.6% retracement and the 162 alternate price projection, more than likely the market is going to find some resistance at this retracement level. So let's add some more data. Kind of a narrow range day, another narrow range, and there we go. As of the last bar in the chart, the market came down sharply from the 78.6% retracement level. Now keep in mind, we identified this in advance, and that's what's so important about our whole approach to trading is we want to have tools and trading approaches and methodologies that help us to identify in advance high probability conditions with high probability outcomes. And so we were able to identify in advance, once this market continued up past this swing high and the 50% retracement, that more than likely the 62% was not going to be a key resistance area, only temporary at best. And if the market continued to the 78.6%, that had the high probability of being a resistance area because it had an alternate price projection very near it, kind of making a little bit of a zone here of resistance, and that's exactly what happened. So we identified that in advance, and boy, that is really helpful when we're developing our trading strategies and when we want to prepare for a trend reversal or support and resistance.
Now, combining retracements and alternate price projections is an approach for all markets and all time frames. We know that we can identify support, resistance, and trend reversal price targets in advance for any market and any time frame using this approach. It's used by all types of traders, from long-term stock position traders to Forex day traders. So really, any market and any time frame, you can use this particular approach. It's quick and it's logical, and it should absolutely be a part of your trading plan. Let's go back to Bob and look at some more specific examples as to how we use this particular approach.
Now we know how to do both the retracements and the alternate price projections, and we know how the alternate price projections help to qualify out which retracement is most likely to be support or resistance. Let's look at several more examples and see how quick and easy it is to do. This happens to be 60-minute data of the S&P cash. This whole approach can be used on any market and any time frame. So let's first do our retracements, in this case from the high to the low, because we're anticipating this market is making a correction. So we'll choose our retracement set. And by the way, you'll see me just pull down these little names of the retracement set. Dynamic is the typical retracements of 38, 50, 62, and 78. And just to show you what we're looking at, this is the dynamic retracement set. So in our Dynamic Trader program, we can set up any retracement sets or any alternate price projection sets that we want, so we don't have to go in each time to check off or enter the different levels. We just choose the set that we want to use. So in this case, we're going to use, we're going to right-click in the little tab. We're going to choose dynamic, and I'm going to choose hot pivots. Hot pivots just make it easier to choose the high and the low for the swing, so we don't have to hit the bar right on. So we've done our retracements from the high to the low. They're noted on the chart, and I have drawn a line across this initial swing high. Since the last bar on the chart has taken it out, now we can do our retracements and our alternate price projections. So we have our retracements on the chart. I just erased the 38% retracement because it was below where the market already is, so it's irrelevant. So that's why we always have an erase function. So now let's do the alternate price projections. So we're going to measure from the first low to the high, this first swing up. We're going to proportion it by our alternate price projection ratios, and then we're going to project that from the next low. So let's do that. And again, I've already got the some of the sets made up. So we got 62, 100, and 162. We'll check on that. We got our icon clicked. So we click on the low and the high, and then we make the projections from the next low. And so the projections are put on the chart. Again, the 62% alternate price projection is below where the market is. We can just erase it to get it out of our way. And let's take a look at what we've got here. By the way, that alternate price projection should be red. I must have forgot to change the color on the sets. So we have the 50, 62, 78.6% retracements. And then we've got the 100%, and the 162% alternate price projection. Now look where this 100% is. It overlaps, it looks like, to the tick, the 62% retracement. And notice that there's no alternate price projection near the 50% retracement. There's one dead on the 62%, and then there's one alternate price projection. It's quite a ways above the 78.6% retracement. So we would anticipate that more than likely, if the market reached this retracement, 62% retracement, which is overlapped by the 100% alternate price projection, that's likely to be a pretty important resistance zone. 50% is not likely to be important because it doesn't have any alternate price projection near it. And the 78.6% is less likely because the alternate price projection is so far above it. So let's continue with our training mode by adding bars and see what the market did. So as of the last bar in the chart, the market has just tagged that overlap of the 50% retracement and the 100% alternate price projection. So far we've reached that level, but let's see if it actually ends up being resistance. So far so good, poked above it slightly. Again, it's holding in there, pokes above it slightly again. So already we can see that we have identified in advance a high probability resistance area, but we don't know yet whether it's really going to turn the market back. Now here we had, notice this, we had a sharp spike above it, and notice the close in that 60-minute bar. So it just spiked up and then came right back down below the 62% retracement. So let's add some more bars and see how it worked out. Let me get my cursor out of the way. Keep adding bars. Boy, look how long it was bouncing around that area and then just fell out of bed. Well, I wanted to use this example because, one, it's a fairly recent one. It's one we had in our report at the time, identifying those levels. And also because it's not that perfect, ideal example where it stopped right at that retracement APP zone. It spiked above it just in one bar and then came right back down, hung right in the zone, then fell out of bed. Now, again, we're just looking only at the price aspect. We have other series of tutorials where we integrate the pattern and the momentum and the time aspect to also help us identify highs and lows. But boy, this just did a great job of identifying a high probability resistance zone and potential trend reversal zone in advance. And again, I want to emphasize in advance. We identified this zone as the highest probability. This retracement area, we identified in advance that the 50% retracement would probably not be relevant, other than maybe real temporary resistance. And if it had gotten above and continued above this 62% retracement, 100% alternate price projection target area, then it would probably have reached the next retracement APP area. But we did identify in advance that more than likely it would be less relevant because they're really not too close to each other, so they're not reinforcing each other. So this worked out worked out super. Look at that. It ended up continuing lower right to new lows. So, alternate price projections help us to identify in advance which retracement areas have the highest probability to be support, resistance, or trend reversal. And again, we emphasize in advance, in advance. Everything we do with the dynamic trading approach is identify conditions in advance that have a high probability outcome, and that's exactly what we did with this example. Well, let's look at more examples.
Let's look at a couple more examples. Here we're going to look at examples with an ETF and with futures intraday data. As we mentioned before, all of our dynamic trading strategies apply to all markets and all time frames. We can identify the high probability price targets where a market will complete a correction and continue the trend using this approach. All right, let's go back to Bob and take a look at some more examples.
So we've had a nice run up in this ETF from the low to the high that's shown on this chart. So let's assume that we're looking for an area of support for this bull market to continue. So if we're looking for an area of support, we'd be looking for an area of which we would have a correction coming down and a high probability price area to enter a long position for the continuation of the bull trend. So let's first do our, we're going to do our retracements. We've got all the right ratios chosen. We've got our dynamic retracements, the 4 key ones. We'll do the, whoops, I missed the spot there. We'll do them from this low and to the high that's on the chart. Let me get all the bars back on the chart. And we've got our 4 key retracements, the 38, 50, 62, 78.6%. Now we've had this market come down, make another rally, and now it's come down, it's taken out this little swing low, so we can do this alternate price projection and see if the alternate price projections happen to fall anywhere near the retracements. So we measure the first decline, and we're going to make our projections from that, looks like a little triple daily top there. See if I can get that bar, there we go. And we've got our 62, 100, and 162. Now, the 62 alternate price projection is above the market, so it's not relevant. The 100% is just below the market, so, and it's nowhere near a retracement. So more than likely, it's not particularly relevant, so we can just click it off. And notice that the 162% alternate price projection overlaps or is within a couple ticks of the 38.2%. We can't even read the numbers on them because they're overlapping, but we know because it's the thick red line, it's the alternate price projection, and the blue line, even though it's the thin one, it's still the 38.2%. And because that alternate price projection overlaps with it, that's our main key retracement area for a possibility of a corrective low. So let's advance the data and see what occurred here. So we advance down. As of the last bar on the chart, the market's reached this zone. And keep in mind, because there's both a retracement and alternate price projection, even though it's the 38.2%, which is the less frequent retracement area for corrections, it's now our key one because we don't have any alternate price projections near the other retracement areas. So as the market comes down, we're going to add some bars. We had a reversal day right at that zone we identified in advance. Market's kind of going up, which is nice. Oop, came back down, tagged that area again. This low is about a tick or two above the low that was made earlier. And then the market goes up strongly. So once again, we're looking at this market activity out of context of any momentum signals or any other trend signals, out of context of the pattern, time, or anything else. But we were able to identify in advance a high probability support zone at one of the retracements and identified which retracement had the greatest probability of being support. And we did it on an ETF. This is applicable to stocks and futures and indexes, intraday, daily, weekly data, whatever. Let's take a look at another example. This is gold, and it's just 60-minute data. And as of the last bar on this chart, we've had a pretty significant rally. We've had a market come down, make a little correction, come down to make a new low. And again, let's assume that we're looking at this kind of out of context, but because we just want to focus on price, but we're looking for a corrective support zone with a high probability of support that would be followed by a continuation of the bull trend. So we're going to do our begin with our retracements. Get the bars on the chart. So we've got our 4 retracements in here. Now let's do an alternate price projection of this first decline. So we click on our alternate price projections. I want to make sure we've got the 3 chosen. We do. Okay. Click on the high, click on the low, click on the next high, and we've got our 3 alternate price projections. Now the 62% is above the market, so it's irrelevant. And the 100%, It's kind of like that last example we have. The 100% is right over the 38.2% retracement, and the 162%, which is usually the maximum alternate price projection, is closest to the 50% retracement. It's above the midway point between the 50 and 62. So if this first retracement zone, retracement APP zone were taken out, then it would be around the 50% and 162 alternate price projection that we anticipate support. Now I'm just going to delete the 62% and the 78.6% because there is no alternate price projections near there. So let's add some data onto the chart in our training mode. As of the last bar, we've come right down to our high probability support zone, and the market came down right below it, and it's oscillating above it, and it just came down below it, and above, below, and above. There's actually some trading strategies we can use when markets just dip below and above and oscillate around a support resistance zone, and we'll teach you those in another series. But here we go with the market continuing higher, and quite a bit higher, gapped up. So far, we did very good in identifying the high probability retracement zone that coincided with a alternate price projection for support. Worked out very well so far. Now I'm going to keep adding some data on this chart because there's another lesson to be learned. We can see it advanced quite a bit. I'm going to actually mark off that low and high. Let's see how many dollars it advanced. And I'm going to click it off hot pivots. There we go, so I can get that high in there. Came up $15 right from within about 50 cents of the retracement zone that ended up being support that we identified in advance as the retracement zone for support. So that's a $15 move. That's a $1,500 move if we got low tick and high tick, which of course in the real world of trading we wouldn't have gotten. But it's quite a nice move. Certainly some quite reasonable profit would have been had from it. Let me continue to add some more bars, because we can see the market came down. Now it's made a new low. It came below what we identified as earlier as the support zone. And the next retracement we have is at 50%. Well, now we've had the decline, rally, another decline. Let's do the alternate price projections of this larger time frame decline from this secondary high. So I'm going to take off the old APPs so we can just erase that group. I'm going to put our retracements back on from the low to the high, so we got them all. We got the four key ones on there. And then I'm going to do the alternate price projection from that high to that low from the next high. So let me do that. We'll click on there. From the high to the low, got our alternate price projections from the next high. And look at this. Isn't this interesting? Is that right at the 50% retracement is the 100% alternate price projection. We skip the 62 and go right down to the 78.6% where we have the 162% alternate price projection. So let's clean the chart up here because we don't need all this data on. We can clean up all the projections that are above where the market's trading. I'm even going to take off that 62%er. Because now we have the 50% and the 78.6%. Both have an alternate price projection very close to them. So the one key piece of information we have here is more than likely the 62% retracement is not going to be relevant. It's going to be one of the other two retracement areas. So we're going to first look if the market comes down around the 50% retracement and 100% alternate price projection. And if it were to continue lower, then we've taken that 62% off because more than likely it's going to continue down to around the 78.6% retracement. Now, that's a pretty exciting thing to know in advance. So let's add some data on. Add some more bar. There we go. As of the last bar in the chart, we've come right down to that first zone that has both a retracement and APP, the 50% retracement, and a sharp decline. Let's add some more bars. Stopping right at that area with the low so far, just a couple ticks below it. And we're adding more data. And if by chance the market continued lower below this area, we'd anticipate it would continue all the way down to the next retracement and APP zone, which is quite a ways below the market. So let me continue to add some data on. Well, now we've taken out, come above the swing high. More than likely, that's going to be a real valid support zone that we identified in advance, and that's what's important. So we continue to add data, and market continues to go up. Look at that, to a new high. So this is, I think, a really key and important example, because number one is we identified that first support zone, and the market did. That right at the zone we identified in advance, the market advanced sharply, but then it did continue lower. So we just add our retracements or alternate price projections, and we see, okay, it's made a new low, around which retracement has the highest probability of being support and ending a correction and then continuing the bull trend. And we identified that could be either the 50% or the 78.6%, but probably not the 62% retracement. So that was an important piece of information that we identified in advance, and we identified how important this 50% retracement was because it overlapped within, I think, 1 or 2 ticks of the 100% alternate price projection, and bang, that's right where the low was made prior to the market continuing up to a new high. So we always want to, as new swings are made, we want to be sure we have our retracements and our alternate price projections all up to date, and we'll be able to identify in advance the high probability support, resistance, and trend reversal zones.
All right, we just looked at examples with ETF and futures intraday data. Now let's take a look at a stock example. Using this approach, we can quickly eliminate the retracements that are not likely to be support or resistance. And we have to remember that what we're calling this dynamic price analysis is a very important part of any trade strategy to identify in advance the end of a correction as well. So let's take a look at this.
Well, let's take a look at an individual stock. This is Hewlett-Packard daily data, and as of the for the data that we have on the chart, Hewlett-Packard's made a significant advance, and then it's making a decline. It's had one swing down, a little correction, and then another swing to a new low. And our objective is to identify a high probability support zone from where the market then would continue its bull trend. So we're looking, in this case, for instance, a support area to which we'd want to look to buy, or that we'd anticipate the trend would continue the bull trend. So let's first, what I'm going to do, I'm going to mark off the highs and lows here. Handy feature we have in Dynamic Traders Group is we can choose how we want to label highs and lows. So I'm just going to label that low and the high and the next low and the next high. So we have that information on the chart. And I guess I should explain what these numbers are. Of course, it has the date of the high or low pivot. It has the number of bars, in this case TB is for trading bars, from the last pivot. So that was a 32-bar rally, 5-bar decline, 11-bar rally. And then it gives, of course, the price of the pivot, high or low. And this number is the range from the last pivot. So from this low to this high was 5.78 points. So $5.78. And then we had a $2.81 decline, a $1.66 rally. So it can be very useful information to have on our chart, the exact date, price, and the price range and the time range from the last pivot. So let's do our retracements, and we're going to do the retracements. Oops, I must have missed that low. There we go. From that low to the high. So we have our retracements on the chart. Now we can eliminate the 30 or erase the 38.2%. just because it's above where the market was trading. And as of the last bar on the chart, the market has come down to just below that 62% retracement. So the question is that going to be the final low of this correction at that retracement, or is it going to continue to the next retracement? Well, let's do our alternate price projections and see if they fall anywhere near these retracements. So we'll make sure we got the right alternate price projections chosen. We do. And I could have done it the easy way just by clicking on that. So we're going to measure the range from that high to that low, and we're going to make our projections from the next high. So we've made our projections. Now we see that 62% overlapped with the 50%, but we're already below that retracement, so it doesn't really count anyway. So we have our 62%, and just below it is the 100% alternate price projection. Now here's our 78.6% retracement, but the next alternate price projection is way below it. It's not anywhere close to it. So more than likely, right around this 62% retracement, and we can just call it a little zone that's been made with the 100% alternate price projection, more than likely that's going to be the end of this correction prior to the bull market continuing. So let me clean the chart up. I'm just going to take that other retracement off because it's probably not going to be relevant, and the 162% alternate price projection off because it was way below the other retracement, and we're going to focus on here. Now just with this last bar, the really wide range bar in the chart, market came down and opened, big gap open, right in this zone, and we wouldn't have been able to calculate the zone until this bar was complete, and then it has closed above the mid-range. So more than likely this bar has completed a correction in the bull trend right below the 62% retracement, which we have identified is probably the retracement that will complete this correction because the alternate price projection fell so close to it, and we didn't have an alternate price projection near the next retracement at 78.6%. So as of the last bar, we're looking for an opportunity to be long, and we've already got that opportunity because we've identified more than likely this market has ended its correction. So we'll add, with our training mode, we'll add some bars on, and that's exactly what happened. Let me get these swings off so they don't confuse us. Market continue higher. Now once again, I got to emphasize every example we look at is that we identify which retracement has the highest probability of completing a support or resistance in advance by applying the alternate price projections and seeing where the alternate price projections, if they're falling near one of the retracement areas. And this is relevant with stocks, it's relevant with futures, it's relative with ETFs, with indexes, with foreign exchange, all markets, all time frames. Now, every market and every time frame doesn't give us some really nice swings to work off of. And so part 2 of this price series is going to show us how we are going to teach you how we use the retracements and a different way of looking at alternate price projections when we don't have these nice clean swings to work off of. But I do want to emphasize there's a lot of markets out there. If you're a stock trader, you have thousands of stocks to choose from. If you're a index trader, you have different time frames and different indexes to choose from. Lots of ETFs to choose from. Why not filter through all of those markets and only take the cherry choice setups that have the nice swings? So I want to put that little piece of information to you, is that we don't have to trade just one market all the time. We can either wait until that market makes some nice clean swings that we can make our retracements and alternate price projections from, or we can look at several different markets until we find the one that is making the nice clean swings. So that's it for this section of our price series, the first in the price series, about beyond just Fibonacci retracements. And part 2 is going to continue on, and we're going to learn when we don't have the nice clean swings, another approach that we use with alternate price projections that's very valuable to identify the support and resistance at retracement zones.
Well, thanks so much for joining me in this part 1 of this price tutorial series. And I know that if you will apply what you learned in this part 1 of the series, you're going to find a substantial increase in the results from your trading activity, regardless of what market you trade or what time frame that you trade. And the key there is you need to apply what you learn, because everything that we teach has practical application for any market and any time frame. And I really hope you're going to join me in part 2 of this series. I'm going to show you other ways to apply alternate price projections and retracements for every market, every time frame, especially when we don't have these nice clean swings to work from. So the key is that by the end of part 2 and part 1, you're going to know how to apply alternate price projections and retracements for absolutely any market condition. So that's very exciting. So I'm Robert Miner with the Dynamic Traders Group, and I look forward to meeting you and continuing in this price series that I know you're going to find as very practical applications in your trading strategies.
Well, thanks for joining us. In this tutorial, you learned about internal retracements and ratios, alternate price projections and ratios, and you learned to identify in advance which retracements are likely to be support, resistance, or trend reversal with alternate price projections. I hope that you're going to join us for part 2, Beyond Fibonacci Retracements, part 2. In the second part of this tutorial, we're going to learn more ways to use alternate price projections. And then we're also going to show you how APPs qualify which retracement is most likely to be support resistance when we have a sloppy pattern. So we really hope you join us for that. My name's Chad James. I'm the CEO of Dynamic Traders Group. Thanks so much for joining us, and we look forward to seeing you in part 2.